Well, hi everyone, and welcome to the Buffett and Beyond Research Saturday ETF report. And our portfolios are outperforming the averages. This is April 12th, 2025. And remember, if you want to live on the beach like Jimmy Buffett once did, you've got to invest better than Warren Buffett does now. And folks, what a week we just had. And let's look at the QQQs. And of course, this is the NASDAQ 100 stocks, and it follows the NASDAQ almost to a T. And this is last week. So last week we left off with this huge double day gap down. Here's the first gap, here's the second gap, and oh boy, what a way to go into the weekend, right? So let's go to the updated. Let's go to today, and we can see where it was last week, these two right in here. And then this week we went up, we went down, we went up, we went down, and right as I'm recording this midday around Friday, we're down a little bit. But you can see the red volume starting to dry up down here, and that's what we were looking at last week, because we had this red line here, this red line here, and that second drop in here was on lighter volume than the other drop, and that's what I mentioned in one of the letters. And so then when it dropped down this day, there was not a very big, it's not a big relatively move relative to what happened the past couple of days, but yet it was still a big move up and down from the high to the low for this particular day. And it did it on a little heavier volume than 2 days previous, but lower than that big drop down in here. So all of that tells us something. And then when we look at the stochastics indicator up here, well, it says we're turning up, and we'll see. And what does this stochastic measure? It measures that the market is closing above the halfway day of the travel of that particular day. So over here you see this black line here and this little nub to the right. Over here, that's where it closed. So you look at that, and that's where it closed. Over here, it closed higher than the mid line, even though it closed down. And then we don't know what it's doing for the rest of the day today, just kind of playing around and getting ready for the weekend. Nobody wants to be long in the weekend, but it looks like a lot of people have bought, because we'll show you our portfolios in a minute, that they've done a lot better. They are sitting a lot better than they were last Friday. And let's look at the SPY. Boy, it looks like the same chart, doesn't it? Then now the SPY is what we use sometimes instead of the S&P 500, which is the SPX, because the SPY is 1/10 of the SPX. So we would expect an exact replication of the S&P 500 chart. So that's what we're looking at, and we might as well be looking at the NASDAQ chart, because boy, it's doing exactly the same thing. And let's look at the utilities, because everybody says utilities are the safe haven, utilities are the safe haven. And folks, when the market, and this is what I want to bring out, when the market goes down like it did last week, it was devastating to every stock. And they'll sell the utilities because they want to preserve money. So therefore, being the safest, and that's in quotation marks, being the safest stocks out there, they sell them off just as quick as they would any other stock. Well, not just as quick, but pretty quick. And you can see that the utilities had that drastic fall. So if you think you're getting into the utilities because of safety, well, yeah, you're getting a fairly decent dividend out of them. But when the stock market goes down into a free fall like it did last week, the utilities are going to go down with it. And in fact, back in 1987, Black Monday, when the stock market crashed, I had put the put options into effect, and it was new at the time, and that was my job, to protect the portfolios. And we were also running a partnership of utility stocks and selling covered calls on the utilities. And the utilities were paying about 7% at that time dividend, and using options and using a discount broker, which was relatively new at that time. In fact, it was very new at that time. We were able to gain another 7% a year. So you could have a utility stock portfolio and get about 14, 15, 16% per year between the dividend and the options. Now, you have to be very patient to run something like that. But that portfolio was also hedged with the index put options, and every day that the market went down, we bought another put option. So here, when that Monday on October 1987, October 19th, 1987, when the market crashed and the Dow went down 22% in one day on what's now called Black Monday, the market went down, the utilities went down with it. And so here we are with utilities that dropped just as much as the other market, the large cap stocks in the Dow and the S&P 500. The utility stocks dropped just as much, but if they were paying 7% before that day, they were paying 14% with the drop in those stocks. I mean, they got murdered. So what we did was sell the put options the day after, because Greenspan said to the banks, back all the specialists on the stock exchange floor. So whatever sell orders that come in on that following day, that following Tuesday, they would be met with the specialists buying and making the market in that stock. So that put a floor under the market. What we did was sell the puts, and we bought lower because the puts were way in the money, and we bought puts at a lower price, but we had a lot of money left over. We went and bought the utility stocks that were now yielding 14% dividend, which held us in place for the next 10 years or so. It was a very, very good move, but we were sitting in front of the computers at that time, and the broker, the discount broker we were using, did answer their phone, where Schwab and Merrill Lynch did not answer their phones because they were just backed up so much. So yeah, you've got to remember, the point I'm bringing out is utility stocks will fall if the market really falls. They'll go down just as fast. Okay, let's look at the ETF All-Stars. Now, this is our portfolio. We picked some of the best ETFs that have outperformed the S&P 500 over the past 5 years, and then we said which are the best stocks in those ETFs, and that's what we did. So last week, the QQQs were down 14.7%. Now, this is the NASDAQ 100, down 14.7%. This week, it's down 13.1%. So it actually rose 1.6%. And the S&P 500 was down 11.6% last week. Now it's down just 11%. But look what our portfolio did. It was down 18% last week, and now it's down only 12.8% for this week. That means we gained about almost 5.6 percentage points, where the QQQs only gained a little bit over 1 percentage point, and the S&P returned only, or went up only 0.6 of 1 percentage point. So that's how fast these portfolios move. Now, if you were using the portfolio protection on this portfolio, and even though we're using the SPYs, we will use the QQQ puts later on after this market gains a hold and starts going back up again. We don't know how long that'll be, but at that we will then be introducing the QQQ puts. But right now we're using the SPY puts, and if you use that, you gained another 4%. Well, as of I'm recording this, because I just figured it out a couple of minutes ago, and so you would only be down 8.8%. So that would be very, very nice. I mean, that's hardly a blip. You wouldn't even recognize that. So if you use portfolio protection, you gain something. The question is, do you sell that now and take that, or do you keep the puts in place? And we're suggesting you keep those puts in place because we don't know what's going to come out next. And when we look at our NASDAQ 100 top stocks, and there's a dozen of them. We went from being down 19.5% to being down 13.6%. So that's a move of 5.9 percentage points that we gained over this past year. So you can see that this gain in this portfolio was quick. And again, if you had the 4 percentage points of puts in there, you would be down 9.6%, which is almost nothing, folks. Well, it's bad enough, but look at the market, down 11%. If the S&P and the QQQs are down 13.1%. So, and these are the returns over the past 5 years. And the point I want to bring out is this top line here is the index, the NASDAQ 100 index. This bottom number down here is the S&P 500 index over the past 5 years. And here's our portfolios. One is our growth portfolio, our 30 stock growth portfolio. And the other one is the sector stars that I just showed you, the sector stars portfolio. So when you look at the returns that you can get from our portfolios relative to what the indices return, and don't forget, 96% of professional money managers cannot outperform those indices over any 10-year period. So you're looking at some pretty good portfolios here, folks. The clean surplus methodology works. It's not that we're stars or anything like that. It's that we're using a system that works, a methodology that works, and it has worked over the past 22 years in real life portfolios, and that's our growth portfolio. So over the past 22 years, we have gained 2.5 times more than the S&P 500. So yeah, that methodology certainly works, and you follow us because we follow the methodology. And portfolio protection, well, we sent out the morning letter and we said this put option that we have here expires next week, but we have $8 of premium in it. And when we actually did the trade today, it had $10 of premium. So we got $10 for this and rolled out into August. And why August and not July? Because I just looked up August numbers, and I don't mind paying $2 for a put, or $3 or even $4 for a put. But by selling the April 510 put and buying the August spread 510, in other words, you buy the 510 put and sell the 455 put. So you're not protected under 455 with the August puts, but you're protected between 510 and 455, and it almost didn't cost anything. Some folks out there who keep in touch with me said it wound up costing them $2 in all, and other people who got the 465 put in there said no, it didn't cost me just a few cents, and others it cost me $2 is exactly what it cost. I skipped July just because that was a mistake, but it doesn't matter. We still have 3 sets of puts in here. And these puts are protected all the way down, the May and the June. So if anything's going to happen within the next 2 months, we're totally protected, 2/3 of our portfolio. And the other third is protected between 510 and 455. And right now, the SPY put, or the SPY itself, is at 524. So it's above all these levels, but these puts have a lot of premium in them right now because everybody is worried and everybody's scared. So, okay, this is crossed out, and we have these 3 puts because we need 3 puts for about $130,000, $140,000, $150,000 portfolio. And then when we look at the XOP, let's look at oil. Oh my gosh, oil came crashing down. Why? Because people are looking at a recession. So therefore, they're saying you have a recession, you use less oil. And we know some of the Arab countries are going to raise their output a little bit, and that is lowering the price of oil. So everybody's happy out there because the price of oil came down, which means gas at the pump is cheaper. But boy, that was some fall. And don't forget, oil was on a nice run. Well, has anything done well? Well, let's look at gold. Yeah, gold is still corrected itself a little bit when the market was correcting itself last week, and not this past week, but the week before. And now it's starting to come back again, but it is, you could see it's near the top in here. Will it go much higher? Not unless a recession pops up and people want to go to gold for safety. Because there was no hiding in the utilities, as we showed. So, folks, we had a rough week last week, and this past week we had a pretty good week, and our portfolios came roaring back very nicely. Still down for the year, but folks, doing very, very well, and we still have put protection in place right around these levels. So, folks, clear your head, go out, go for a walk on the beach. Go for a walk any place, be with your family, have a great weekend, have a safe weekend, and we'll see you right back here in a couple of days.